What if the reason you keep missing clean setups has nothing to do with skill and everything to do with how crowded your chart is? Too many concepts, too many indicators, too many zones all screaming for attention at once. In this video, we cut through the noise and combine only what actually works: supply and demand, order blocks, liquidity, and pure price action into one clear day trading strategy built for consistent results. So, if this type of content is valuable to you, remember to like the video, subscribe to the channel, and enable notifications so you don't miss the upcoming lessons. And feel free to share in the comments which topics you would like us to explore in future videos. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to continue producing this kind of educational content. Now, let's begin. This is a day trading strategy, which means every position is opened and closed within the same trading day, with no trades held overnight. To use this strategy effectively, we first need to build a solid foundation. And that foundation comes down to three things: understanding how price reacts around the important areas on the chart, recognizing how control of the market shifts between buyers and sellers, and knowing when a setup is actually good enough to trade. So, before we break the full strategy down step by step, let's start with the core concepts that make it work. We will begin with supply and demand. Supply and demand zones are areas on the chart where a large number of participants entered the market at once, pushing price away from that level aggressively. That aggressive reaction is a clue. It tells us strong buying or selling interest may still be sitting there, waiting to act again if price returns. For that reason, we mark the origin of every strong price movement as a supply or a demand zone. When price returns to that area, we expect a potential reaction because for some reason, traders were highly active there in the past. However, not every supply or demand zone deserves to be traded. To identify stronger zones, we focus on three important factors: inefficiency, break of structure, and the distance price moved away from the zone. These factors help us evaluate the quality of the zone and improve the probability of finding a successful trade. Inefficiency happens when price moves away from an area very quickly, leaving an imbalance between buyers and sellers. This imbalance often appears on the chart as a fair value gap between candles. A fair value gap suggests that price moved too fast and did not spend enough time trading through certain levels. Because of that, price may return to those levels later, making the demand zone that created the gap an important area to watch. A break of structure happens when price breaks a recent market structure level to the upside in a bullish scenario. This shows that buyers are still in control and that the current trend may continue. The distance of the push refers to how far price moves away from a zone before returning to it. The farther price travels away from the zone, the stronger the rejection is usually considered, which can make that zone more reliable. By combining inefficiency, break of structure, and push distance, you can identify stronger supply and demand zones and focus on higher probability trading opportunities. In this example, the latest impulsive movement meets all the criteria for a high-quality demand zone. It created a fair value gap, broke through the previous market structure, and pushed price higher by a significant distance compared to previous movements. Once price retraces back into this demand zone, there is a higher probability that it will reject the area and continue moving upward. But what happens if price breaks and closes below this high-quality demand zone? This brings us to the next smart money concept: the change of character. Going back to the previous example, if price breaks and closes below that high-quality demand zone, it tells us the buyers failed to defend the level, and the sellers have stepped in. The market structure has shifted. Momentum now favors the downside, and the uptrend may be coming to an end. This shift in sentiment is what we call a change of character. But here is the catch. A change of character is not always real. There are two common traps where it looks valid on the surface, but is actually misleading. Let's go through both. The first trap is the liquidity sweep. This usually shows up in messy, imperfect trends, where price forms what looks like a change of character, and then simply keeps going in the original direction, trapping everyone who thought the trend had reversed. Let's break it down. Say we have a swing low and price breaks below it. At first glance, that looks like a valid change of character. But before you trust it, look to the left side of the chart. If that swing low lines up with a significant liquidity area, the story changes completely. Many traders went long at that level and placed their stop losses just below it, which means a large pool of liquidity is now sitting right under the low. For smart money, that liquidity is a target. Price gets pushed down just far enough to sweep those stop losses, and then it turns back around and continues in the original bullish direction. So the key takeaway is this: when a major swing low sits inside a liquidity area, a break below it may be nothing more than a liquidity sweep, not a true reversal. In that case, we do not treat it as a valid change of character. In fact, once price re-enters the range after sweeping that liquidity, it can offer an excellent long opportunity. The logic is simple. The overall trend is still bullish. The sell-side liquidity has already been taken, and the next target becomes the buy-side liquidity above. As smart money traders, this is exactly what we want: to enter after the stop losses are gone and the real move is ready to begin. That is the first trap. Now let's look at the second one: the unmitigated fair value gap. In situations like this, price will often retrace into the fair value gap to fill the imbalance before continuing in its original direction. This pullback does not necessarily indicate a true reversal. Instead, it can simply be the market rebalancing itself before continuation. The key takeaway is to always check the left side of the chart for unfilled fair value gaps. This will help you distinguish between a move that is only filling an imbalance and a move that represents a genuine shift in market sentiment. By understanding this difference, you can avoid false signals and stay aligned with the overall market structure. Now that we have covered these concepts, let's talk about market direction and answer one of the most important questions in trading: who is in control? Identifying market direction is the first step when analyzing any price chart. The goal is to understand the trend and determine whether buyers or sellers are currently controlling the market. Trading in the direction of the dominant side increases the probability of success and helps you stay aligned with the broader market momentum. So, how does this system work? The system is based on mitigations. When price mitigates a demand zone, demand takes control over supply. On the other hand, when price mitigates a supply zone, supply takes control over demand. I know this may sound very simple at first, but it will become much clearer in a moment. Imagine the market is in an uptrend, forming a sequence of higher highs and higher lows. Every time price breaks structure to the upside and creates an inefficiency, a new strong demand zone is formed. These demand zones remain unmitigated until price comes back to revisit them, creating potential opportunities to trade in the direction of the dominant trend. However, if price breaks below a valid demand zone, it creates a change of character. This tells us two important things. First, supply has taken control over demand. Second, a new valid supply zone has been created. From there, price continues moving lower, forming new supply zones until it reaches the next unmitigated demand zone. At this point, a battle between supply and demand begins. Sometimes this battle creates consolidation, causing price to move sideways between the supply and demand zones. A break above or below that range will determine which side gains control of the market. After that, we look for trades that align with the dominant market direction. The next concept we need to explore is order blocks. Order blocks are refined supply and demand zones where significant buying or selling pressure originated. These areas are important because they represent locations where large market participants likely entered their positions and caused price to move aggressively in a specific direction. We identify the first candle that creates a fair value gap as the order block zone. This is because the decision behind the strong move most likely originated from that area. When price eventually returns to the zone, there is a higher probability that it may react. However, the strength of that reaction depends on whether unfilled orders still remain inside the order block. It is important to understand that order blocks do not always work. They are not guarantees. They are potential trading areas where price may show more predictable behavior. Like any trading tool, order blocks should be used together with other concepts and confirmations to increase their probability of success. Finally, Let's discuss top-down analysis. This technique involves combining multiple time frames to build a complete view of market conditions. By analyzing the bigger picture on higher time frames first, and then zooming into lower time frames for more detail, traders can identify higher probability trading opportunities. The process begins on the higher time frames, such as the weekly or daily chart, where we identify the overall trend, key levels, and market sentiment. This broader perspective helps us understand where the market is most likely headed. Once the bigger picture is clear, we move down to lower time frames, such as the 4-hour or 1-hour chart, to identify more precise entry and exit opportunities using the concepts we have covered in this video. The most important thing to remember is that we do not want to overcomplicate our trading. Now, let me show you how they come together on a real chart. Here we have $-yen on the daily time frame. On this higher time frame, the only thing we want to mark on the chart is the key supply and demand zones near the current price. At the top, we have the most recent high. At the bottom, we have the most recent low. These levels are important because if we zoom into the lower time frames, we can see that they acted as turning points for short-term trends. So, when price reaches these levels again, we can expect a possible reaction. We can also notice something else when we focus on the latest bearish impulsive move. This move created a bearish fair value gap, so we can mark the candle responsible for that imbalance as an order block. This bearish order block becomes a potential area to look for selling opportunities. At the moment, price is trading near this level. However, the daily time frame is not our entry time frame. Because of that, we need to zoom into lower time frames, such as the 4-hour and 1-hour charts, to look for confirmation and a possible short setup. Overall, the higher time frame is bearish, and there is still room for price to move lower before reaching the next important demand zone. This is all we need from the higher time frame. Identify the overall market sentiment and mark the key levels. Now let's move to the 4-hour chart. Once again, our goal is simple. We want to identify the market direction and mark the important levels. The market is in a clean downtrend, respecting lower highs and breaking lower lows one after another. This gives us a clear support level to mark on the chart. The analysis remains the same as on the daily time frame. Market sentiment is bearish, and we want to look for selling opportunities that align with the dominant trend. However, we still do not have a strong reason to enter directly from the daily order block. So, let's move down to the 1-hour chart and look for a better entry. On the 1-hour chart, things become more interesting. Unlike the higher time frames, the short-term direction is bullish. The latest impulsive move created an imbalance, showing strong demand. We can mark the candle responsible for this imbalance as our order block zone. To refine the area even more, we can also include the wick of the next candle. When price reaches this 1-hour order block, we expect a battle between supply and demand. If price breaks and closes below the order block, it suggests that supply has taken control. If demand remains in control, price may continue higher and even break above the daily order block. Now, let's see what happens next. Price breaks below the 1-hour order block, confirming that supply has taken control. Because of this, the chart creates several interesting possibilities, and you can use different entry models depending on your trading style and risk profile. As you can see, price created a CISD, a change of character, and also a breaker block. This is a strong indication that the short-term bullish move is over and that price may continue lower in alignment with the higher time frame trend. So, where do we enter the trade? There are different ways to enter in this situation depending on your strategy. In my case, I prefer to wait for the change of character and enter when the candle closes, confirming the shift in market direction. For safety, I prefer to place the stop loss above the breaker block. The first target is at a 1-to-1 risk-to-reward ratio. When price reaches that level, I close 50% of the position and move the stop loss to break even. This helps protect the trade and secure part of the profit, even if price later moves back against the position. The second target is placed at a 1-to-2 risk-to-reward ratio. As the chart continues, you can see that the trade worked well. Price moved in our favor and reached the final target at 1-to-2. So, trader, if this video helped you gain more clarity, make sure to like the video, subscribe to the channel, and turn on notifications so you do not miss the next lessons. And let me know in the comments, which topics you would like us to explore in future videos. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro Trader community right here on YouTube. It's a simple way to support the channel and a smart investment in your growth as a trader. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to keep producing this kind of educational content. Please also remember that the mission of the ComLucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you will find complete courses designed as a true trading masterclass. We teach liquidity, market structure, higher time frame analysis, and supply and demand, always focused on understanding price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency, because trading is not just about charts. It is about mindset, discipline, and execution over time. Our main courses include Smart Money Concepts, ICT, Technical Analysis, Trading Psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you better understand how markets really behave. Thanks for watching, and I will see you in the next video.